Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of Wall Street. Today we're diving into QHSLab's latest annual report, and let me tell you, it's a bit of a financial roller coaster. Buckle up, because this could get bumpy. QHSLab, a company in the business of medical device technology and software, wants to help primary care doctors make more money. How? By giving them the tools to handle chronic diseases and offer preventive care in their offices. Essentially, they're providing software, training, and devices so these doctors can treat patients with things like allergies and asthma, maybe even mental health issues like anxiety or sleep problems, which they might have previously sent to specialists. This annual report covers their performance up to the end of December 2024, so let's dig into the numbers and see how they are doing. It's their annual report, which is basically a yearly checkup to see if the company is healthy. They tell us how much money they made, what problems they faced, and what their plans are for the future. Here's the headline: they lost money in both 2024 and 2023. Specifically, they lost about $259,000 in 2024. Losing money is never good, and this is a key point we'll keep coming back to, but it's important to put it into context. Their accountants are worried. They said that because of these losses, there is doubt whether QHSLab can continue as a going concern. That is, accountants speak for being worried about the business might be in danger of failing and closing its doors. QHSLab has a lot of debt, over $2 million worth. They have taken out loans and lines of credit to keep things afloat. Two big loans with balances totaling over $1 million are past their due dates. They received a notice of default from one of their lenders, Mercer Street Global Opportunity Fund, meaning QHSLab didn't meet the loan terms. This could allow the lender to take action, possibly even seize company assets. The company has already accrued significant default interest because they haven't been able to pay the loans back. The company's stock held by non-affiliates was only worth around $1.7 million, a pretty low number. They had over 11 million shares of common stock outstanding. This is important for understanding how much each share is worth. The main thing to know is that QHSLab is aiming to enhance chronic and preventive care management through data analysis and remote monitoring. Their key product is the QHSLab Expert System. It's a software platform designed to capture, store, and analyze patient data to help doctors make better diagnoses and treatment plans. They also offer the Allergy End system, which helps primary care doctors test and treat allergies in their own offices. This allows them to offer more services and make more money. Q-Scale is a questionnaire to measure psycho-emotional factors in patients at risk of mental health issues, which is something they will keep working on in the future. QHSLab wants to grow by getting more doctors to use their services, adding new products, and increasing their visibility in the medical community. They face a lot of competition from other companies in the healthcare technology space. Many of these competitors are bigger and have more resources. The healthcare industry is heavily regulated, and QHSLab has to comply with many laws and regulations. These laws cover how they bill for services, their relationships with doctors, and their marketing activities. It is possible that some of QHSLab's business activities could be challenged under one or more of these laws. One goal of the company is to increase the number of medical practices and their use of point-of-care and digital medicine services. All of their revenue has been from a limited product line, so they are constrained in growing and need to diversify. They depend on third parties for their products, which means they are vulnerable to supply chain issues and price increases. They are in a competitive industry, and their success will depend on the ability to recruit and retain the required talent for their operations. On June of 2024, the aggregate market value of our common stock held by non-affiliates was just around $1.7 million. There may never be an active market for their stock, and it is likely to be highly volatile. Let's switch over to the financial section, which is really the heart of this report and the most useful for investors. This shows the company's financial performance over the past year, highlighting their revenue, expenses, and ultimately their profit or loss. The numbers tell the story. Total revenue for 2024 was $1 million, a significant increase from $1.4 million the previous year. The increase was attributed to growth in revenues generated from their integrated service program and sales from allergy diagnostic kits. Their net operating income was about $205,000 in comparison to a loss last year. It is a reflection of growing sales and better margins. Interest expense increased by $234,561. This was an increase due to defaulting on their high debt payments. They generated positive cash flow from operations of $132 and $432 and $430 and $49, $627 the previous year. This is a nice step in the right direction. But here's the thing, they are still in the red overall, and it is mentioned that there is doubt whether or not the business will remain open. This depends on more financing and profitability in the future. Finally, they talk about cybersecurity. QHSLab says it prioritizes the security of health, financial, and insurance data. They also look at third-party vendors' security practices to ensure they meet our strict standards, especially when they have access to sensitive data. During the past year, they haven't had any material incidents, but they acknowledge this might change in the future. Their management has a comprehensive incident response plan to address any incidents. So what's the verdict on QHSLab? They are in a tough spot. On one hand, they have revenue and some pretty good growth. The increase in revenue shows they are going in the right direction, and positive cash flow shows that they are learning to control expenses. But the elephant in the room is their high debt and the real possibility of not being able to remain a going concern. Ultimately, QHSLab faces an uphill battle to turn things around. They need to significantly increase revenue, manage their debt, and continue to innovate. If they can't, they might be another statistic in the high-risk world of small-cap companies. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more corporate deep dives. Until next time, keep those investments smart and stay informed.